everybody, this is Phil Town.
And this is Danielle Town.
Welcome to the InvestED podcast. We're back with more in-depth investing stuff.
Just more.
For those of you who, you really want to do it the way the best investors in the world do it. And I'll happily include myself in that number.
Oh my. This is a world first.
Oh my God.
Good heavens.
Oh yeah.
Look at you getting excited.
Yeah, well, I gotta pat myself on the back one time in 76 years. I'm gonna do that.
Do you want to say why you're patting yourself on the back?
I don't know if I can.
Yeah,
I guess I can.
Either. But okay, so you say nothing. I'll say a rough piece of information, which is that my dad's fund is doing extremely well and is in fact number one in its group, according to a disinterested third party. Very reliable. And has been for, I think, 5 years. Don't answer that. I don't know if that's right, but I think it's roughly
can't answer
right.
that.
So yeah.
You're like the CIA, like I cannot comment.
Yeah, that's
on
okay.
The accuracy of this information.
It's good for you to learn how to not comment. Just zip that lip.
Oh my God. Yeah, exactly.
Exactly. No, it's good. And I think we take our wins when we can get them, like there's down times as an investor, and maintaining the confidence is hard. And I think when we're up, take it. It's awesome.
Yeah. I mean, these 5 years are really, for a value investor, they're very trying. Yeah. Because the market has been, as we've said many times, vastly influenced by the Federal Reserve, by fiscal policy. And it just means they've poured trillions of dollars into the U.S. markets, and that money just ends up in real estate or stocks investing, by and large, gold, Bitcoin to a certain small degree, but it lands in assets because ultimately it ends up in the hands of people where it stays who have plenty of money already. That's why it's not getting spent; it gets invested. So that's driven the market to extremes that we've never seen this consistent extreme ever in my investing life of 40 years. And it's fascinating to me now that Warren Buffett is really withdrawing from the market. I have only seen him do this a couple of times in the last, really. I haven't seen him do it, of course, in the early days, but he did it in the 1980s in a big way. And again in 2007 and 8.
Yeah, he's been selling a bit, hasn't he?
Wow, he's sold off chunks of Bank of America. These are sort of, how he has the right hold period is, the right time to sell a stock is never.
Yeah.
And Apple Computer, by all accounts, is one of his favorite investments he's ever made. It's certainly been very profitable. And he's sold off an enormous block of it. I mean, it's really a big sell-off. And the combination of at least those two plus income and cash flow has him now at $325 billion. I mean, $325 billion. Think about that.
In cash, you're saying.
In cash. Sitting in short-term U.S. treasuries. And one of the reasons, by the way, we last podcast, I sort of pinged the All In podcast, and I think I'm just going to give them a big shout out because these guys are really good and they're really balanced and they're really smart and they're really rich. And they do this podcast for free. There's no advertising on it. It happens every week. It's a long podcast. It lasts an hour to an hour and a half. And they are venture capitalists out of Silicon Valley. And they're just smart guys. I'd really recommend you watch it. You will get a heads up on the direction of things better than any podcast I know of, honestly. It's just, they're really, really smart and really have a bead on things.
I've never listened to it. So, yeah.
And what one of them said about this reason that Buffett has got $325 billion in cash is, he said, if you think about it, now these guys are venture capitalists, so they're looking at putting money into new companies. And they said, you think about it, as companies go through these cycles, and you know more about this than I do because you did law in this area, where they're recapitalizing the company or adding more capital, and the new round of capital always wants to be at a higher valuation than the old round of capital.
Yeah.
And I can't back up any of this data, but I think roughly what was being said was that new rounds of capital are going out at, broadly considered, about a 23 PE.
23
So
in
yeah,
venture capital.
in on future rounds, right? These are companies that are doing well.
Oh,
They're
okay. Okay.
private, but they need more capital. So here it
Okay.
comes. And what
Got
are
it.
they putting it at? Which is a
So
problem.
more
It's a
late stage
problem,
company.
right? Because wait a second, I put in a round of capital earlier and it was a much higher PE ratio, and now it's this low PE ratio, right? So there's a problem, and that's kind of where they started talking about it. But then they shifted over to this 325 billion, and they said if you think about it, if you're getting 4.5 to 5% yield on a U.S. Treasury bond, and a U.S. Treasury bond is traditionally the zero risk investment that you can make,
Mm-hmm.
right? So they call it a risk-free investment is a U.S. Treasury bond. 10 years are now running 4.5 to 5%. If you were to get 5% for this thing, that means you've got it at a 20 PE. And said, think about it. Why would you put money into a high risk, might go broke company at a 23 PE if you can put your money in a risk free investment with a 20 PE?
Yeah, as treasury bonds get higher returns, and that rate of like, well, this is my basis level return, risk-free rate goes up, it really starts to make stocks look worse. I
It
think.
does.
I think
It
some
does
people
indeed.
think that it shouldn't matter, but it does, because inherently it's a risky activity to put money in any company, much less like an early stage or late stage startup that's, still getting its feet going, still taking
Right.
rounds of investment.
Right.
Any
Yeah.
company. Like, I had
Yeah.
somebody say to me a number of years ago, something like, oh, well, I just don't have time to learn investing. And I think I'm just going to buy Boeing because Boeing's such a good company. And I was kind of like, this
Oh,
is
that's
years
so
ago, years
sad.
ago. And I was like, you might want to think about that. And this person was like, oh, you don't think Boeing's a good company? And I was like, honestly, I haven't researched them. Like, just because they're around doesn't mean they're good. And and I always think of that when like all the news came out about Boeing, which has shown them to be a much less reliable blue chip type of company than they seem to be. So
That which
yeah,
really reminds me of a story I know I told way early on in the podcast years ago about this same exact thing. Um, I a friend of mine asked me to pick up a friend of his from an assisted living home to take her to his wife's birthday
you
party.
didn't only tell this on the podcast, you put this in rule number 1 in the first book.
I put it in the book.
Yes.
Tells you how long it's been since I've read my own book. Well, read the book then and find out what I'm talking
Now you
about.
can tell the story.
Okay.
Tell the
Well,
story.
the bottom line is her husband had passed away, and before he did, he told her as much as he could about, how to handle their finances in the future without him. And he said, I've been in this stock forever. It's the best thing to do. Just leave your money in it. It was General Motors. And this was this, I might have put this did I put this in invested?
No, you put it in rule number 1.
God, I thought it happened after I'd written rule number one, where I blasted GM, but maybe not.
I mean,
So,
that's what I remember.
in any case, we'll have to
I'm
go look
pretty
it up.
sure.
But yes, I did write my own books.
You
Just
did.
been a
I
long
can
time since I
attest to
looked
that.
at it.
But yeah, it was rule number 1 because that was a big part of you figuring out that you needed to, well, you already knew, but like that other people didn't know that finding out about companies was important.
So I probably was researching GM at the time because I definitely put it into the book. And I had seen that they were actively borrowing money to pay dividends, which is a huge red flag. Their cash flow was not positive, and they were borrowing money. They were faking it, in other words. And that is a early sign of a company that's going to be in real trouble. And their debt was growing like crazy. Ultimately, of course, you know the story. They went bankrupt and wiped out all the shareholders, which means that woman's substantial portion of her money to live on in her retirement was taken away completely.
It's
And
horrible. It's just horrible.
That's horrible.
It's
a heavy price to pay for ignorance, don't you think? And so,
yes, yeah, that's a good way to put
and
it.
Here's one answer, and I think this is the answer Buffett would give: is be just, well, you just put your money in a diversified index like the S&P 500, and you just put it in there and leave it in there. And the only problem with that advice is that you could be coming up on the regular periods in the market when the market goes nowhere for gigantic periods of time. And if you happen to be retired during that period, that's kind of a problem, right? In other words, you're not getting the income, you're not getting the growth you need to have that you expected to have in order to have enough money when you're 90 years old.
Right.
And unfortunately, you guys, and I've been saying this for 5 years. So I don't blame you if you think I'm full of it. I really think we're there now, and I don't see how this game keeps going, where they just keep printing money to continue, the game of musical chairs, and to keep paying people so you don't have a market crash. Right now, we're at a market PE of, I think, well up into the 20s. On the Schiller PE ratio, it's way up there. It's like at a 28.9 or something, which is almost double the historical market rate of return adjusted for inflation. So it's like, wow, we are still flying way high, and we can't fly here forever, which means it's very unlikely we can go up. So your best case scenario for the next 10 years in the stock market, according to a lot of people, and I would agree with this, is you're going to get a 1% return, 2% return, something like that for the next decade.
In the market overall, though.
Yeah, market overall. So if you shift from a Boeing, where you're about to go bankrupt and don't know it, or a GM, same thing, a single stock picking without knowing what you're doing, over to a diversified portfolio, you very well could be moving over to that portfolio right when the market goes nowhere for a long period of time. And so people know this, and it makes them scared. And it's one of the reasons the annuity market is so on fire right now, is because you can get an 8% return, 9% return.
Oh, is it? Oh.
Yeah. You put your money in, and you can buy yourself a pretty decent return on your money right now. And of course, the problem with the annuity world is that it's locked in, and it does not adjust for inflation unless you pay for some expensive rider to do that. But if you're just looking at apples to apples, it's not, you're locked into, $6,000 a month. And 20 years from now, when you're out living your demographic and really glad you have this annuity, that 6,000 is going to buy about $3,000 worth of stuff. And so the annuities are a real problem. So I really think, obviously our answer to this on this podcast and in our lives is learn how to invest. It's not that hard. It's really simple, actually. What's the right way to say this? It's really simple. It's just like you've got to really apply yourself. So I shouldn't say it's not that hard. I would say it's not that complicated. It's pretty simple, but it's not easy. You have to do it, and you have to control your emotions in the market. And that is hard to do when you're not sure you know what you're doing.
Yeah.
So,
I think it's not easy. Yeah.
Yeah.
Is that what you
So
just said? I'm not sure.
Yeah. And for that, I'm wandering back to this Japanese company, but not very well.
Yeah. Let's get back to the Japanese company.
All right.
I'll add quickly on that, though, that one thing I've discovered as a benefit I did not predict is that if you can't do any investing or investing practice, which has been me for the last 4 years, except for really doing our podcast and the writing that I did when I first got sick and thought that I could still do that. And having the confidence that what I own, that I did the work, I'm going to stick with it, yes, things change and there's that scary possibility, but as much as possible, I've made good choices for my investments, and I can sit back a little bit, and it's okay. It doesn't have to be active all
So
the
true.
time, is what I'm saying.
So true. I mean, and I know we've talked about this too, but just going back to that first class that we did in Singapore, where the students picked 10 companies and we ran those companies out on, like on a paper trading basis with 10,000 invested in each of those companies, $100,000 total. How would that portfolio have done over all of these years if you just left it alone, right? If you just totally left it alone. And these are the best companies that between the students and me, we could put on the list of businesses on this portfolio that they had picked out in class. All right. So here we go. And you get this 10 companies. That sucker, by 2019, it was at a 32% compounded return without
Whoa.
considering dividends at all. Now, I don't think there are very many of these were dividend companies, but 32% compounded. Then, as the market sort of flattened out and some of these guys didn't do it, and right now it's running, I think, 25%. We were talking 25%
is the
for
low.
50.
Is the thing where you're like, oh, 25.
Yeah,
Oh,
only
oh
25.
man, I'll take that any day. Good
But you
Lord.
you remember the rule of 72, right?
Well, I
The
do
rule
because you talked about it last time. Yes, I
rule of
do.
72, divide 3 into 72. 3 into 72 goes 2,
3 into 72.
and they carry a 1, 2, which is 4, right?
Yeah.
24%.
Yep.
In other words, if you get 24% compounded return, you're doubling your money every 3 years. These guys have 25%. They've been at it 15 years. That's 5 doubles, right?
Yes.
Every 3 years, it's actually faster than that, but let's go every 3 years, it doubles once. So if they started with $10,000 in that portfolio and just went to sleep for 15 years and didn't touch it, and never mind that some of those companies did badly, right? Let's just keep the money in there. They're just asleep at the wheel. So there's all human judgments taken out of it except for the original judgment to put the money in. You've got 5 doubles. 10,000 goes to 20, 40, 80, 160, 320,000 on
Wow.
$10,000.
Wow.
Dude,
Wow.
that's so powerful. So hooray for
Do you
not
think
doing
anybody
anything.
actually did it?
No, chances are. Chances are pretty good. Nobody actually did it, including me,
Yeah.
right? No,
Oh
I
my
had my own view
gosh.
of things. And I will tell you, I didn't do that well over that period of time, but we did well. We did well.
I think there's a I'm sure there's a good name for this, but there's a fallacy of thought in that we think that the more we do, the better we are.
Yeah.
And the more we do, the better we'll produce. And the more we
Yep.
do, the more we'll XYZ. And in many things that is true. And in some things it's not. And
Yep.
I think investing, part of the huge challenge is knowing, well, I feel like we can't really ever know, is guessing when to stop. When is like, this is what I'm sticking with. And when is it, I need to go full force? Or like last time you said, like you had 2 months to research a company before it doubled and didn't make it in the 2 months.
Didn't make it. Yep.
And that should have been like a all hands on deck, go really fast kind of
Yep.
situation. Lots of work.
Yep.
Work is good. Work helps.
Right.
It's like those two sides of the coin exist and they're never going to change. And I think like the great investors somehow divine which one to do when.
I agree.
Some of the
I
time.
agree.
Not
I
even
agree.
all of the time.
I agree.
Like look at
Totally.
you. Okay. You constantly talk about things you get wrong. Buffett constantly talks about things he gets wrong. Everybody does. And so like just expecting that that's part of it is good, I think. And then getting the rest of it to just be good choices and sort of stay away from it. It's extra, like that's where the gravy is, you know? It's
Yep.
wild.
Yep. And I have to say that there's, you watch an investor who is the best in the world pushing, coming out of investments that are, many people think are the best companies in the world. Apple, for example, coming out of that investment, but keeping a chunk for sure, but largely bringing the money out and stacking up 325 billion. And I will not be the littlest bit surprised if within 18 months, Buffett is buying $325 billion worth of companies that have gone on sale, that the market crumbles and he's standing there with this enormous hoard of cash. And I know he wants to, because he would love nothing more than to put all that money to work before he really is done, right? Before
Yeah,
it's all
I
over,
agree. Yeah.
and leave this amazing legacy of here goes another 10 years at 30% a year as these companies recover and come back into their true value.
Oh, but I
And
think it's also probably, I think for him, it's also like knowing that he could make a huge difference in the American economy and help it to come back
putting a
from a
bottom in, you
crash. Yeah, I
bet.
really do. I feel like
Yeah.
that's something that he's talked about and that he's super proud that Berkshire could do that.
Yes.
And I think you're right that before he hangs it up, not that he wants a crash to happen, but if it does, he would like to be the one to help.
Yep. 100% right. And that's his promise, is that Berkshire will be here. If nobody else is here,
Yeah,
probably including the
exactly.
federal government, I mean, Berkshire will still be here. And so I think we all need to pay a little bit of attention to that. But it is ironic for a guy who is the investor who says buy, hold, never sell, to be unloading and gathering up cash. And had I not seen historically that he's done that repeatedly in his career, because at the end of the day, what he said 7 years ago in 2017 was that every 7 to 10 years or so, there's an economic storm and it rains gold.
Mm-hmm.
And you have to be ready to go outside with a bucket, not a thimble. A bucket is cash,
Mm-hmm.
right? You can't, if you're just invested fully, there's nothing you can do when the opportunities show up because you're already invested and everything you own has gone down with everything else. And now
Yeah.
you can't buy more. So there's the
I mean,
conundrum
the thing
of
is, it's
this.
all been said for so long that, you know, the clock strikes 12 twice a day. So it's,
Even a blind dog gets a bone. Your turn.
yeah, I don't know. I don't know where it's going to go. But so tell me about this company, Terumo, that we started talking about last time.
Okay. Because
Um,
we're always looking. We're always looking
yeah, and
to
that's the
put
fun
companies
part.
on a watch list that are just, world beating, well run companies that are essentially their own kind of monopoly. And so we started this with this idea, oh, maybe these guys have a monopoly in some part of their business. And we started to dig in. And what we found is they had a 18% per year growth rate in their stock for quite some time. And then now it's shifted to about a long-term 12%. The market is fully valuing them, if these are the accurate numbers. So probably we're not in a big hurry here. This is not on fire on sale. There doesn't seem to be any event around this company that has driven the stock down, other than they loaded the market with medical equipment and supplies, and then COVID didn't keep happening, and the whole world doesn't need to buy those supplies at that same rate. So that's an event, but that's being worked through now. And the question is, do we really like this company? Does it look right to us? So now, this being a Japanese company, I could check our own website, and I guess I should. Why don't I do that for a second, real quick?
Sure. Uh,
Um, Going over to the toolbox here and log in.
well, so what we talked about last time, just to fill while you are doing that, was if you randomly come up with a company as I did out of the sheer blue that you've never thought about and want to go figure it out and look at it, what do you do? So we talked about go to their website, not even the investor website, just the regular
Go
website.
on their website, yeah.
Go to just like Google and then look at the basic stock charts, basic financial info that Google gives, and just get a very, very broad, what the heck even is this company? What do they make? What do they sell? Where are they? And what do they purport to be doing in the future? And what we found about Terumo very quickly was that I thought they only did blood related supplies, but turns out their vision is that they are a medical technology company. Full stop. So they want to do all sorts of things. And then I think the next question for me is, what do you do then? So those sort of basic, like, okay, I did my Googs. What happens after I know what they do, where they are, what's going on with them, and I have enough interest to keep going? So what
What do
I
we
do
do then?
is go more immediately. People always ask me, like, where do you go first? So what I do is I go to the investor website. Sometimes they have a good one, sometimes they don't. A lot of times these days they do. And look at what they're presenting to investors and I don't know. I try to see, like, do they give the annual reports proudly? Do they have letters from the executives on there right away? Are they putting forward with pride what they've been doing? Or is it really hard to find the annual report, or they don't even link to it, which
Right.
happens? Um, and that tells me something. And then I go to the most recent annual report. That's what I do. What do you think about that?
I think you're pretty right on, although I'm not really rigid about that flow.
I'm
It's
not
kind
rigid
of,
either, but that's just sort
yeah,
of like, oh, what do I do? Okay, I'll do that. That's my
yep, yep.
basic.
So let's do that. The first thing I do is I go over to my own website to see if we're picking up this company, and we're not. And I'm not sure why. It's an ADR company, and it's traded over the counter, which means that the company doesn't really have to file all the reports that a fully listed company has to file. And so we don't spend a great deal of time on over-the-counter companies, in part because it takes more research to dig into it. So being aware of that.
You
All
know,
right.
one thing though we did talk about for a number of episodes was that those kind of companies, well, this one's OTC because it's foreign, but that those kinds of companies that are harder to know about might be opportunities for those of us who are starting with
100,
smaller amounts of money.
100% right on that. You're
Yeah.
absolutely 100% right. This company is not a small company. It's 4.6 trillion in Japanese yen. So if you'll tell me how big that is.
Well, I'm going to have the internet for that.
I suspect with 30,000 employees, they're probably
Oh, it's a huge company.
everything on here is
What did you
yen
say
for
it
some
is?
reason.
For what?
4.6 trillion in JPY. You know, do the conversion. 4.6 trillion.
Roughly
Mhm.
30 billion.
About 30 billion. So there you go. Not exactly a small cap, right? So they're quite large. And so, all right, they're a big company. Let's go figure out if we're interested in them. So my next step is to read a little bit about what they do, a little bit deeper, right? We led that one paragraph. But
Mm-hmm.
now I want to know a little more, because before I start digging into numbers, I do kind of want to get a sense of whether I feel comfortable in this particular industry group,
Yeah.
medical devices. I haven't owned a business in this area, so this is a little bit new, but I've definitely researched companies in this area. In particular, when your sister started doing surgery using Intuitive Surgical's devices, the Da
Oh,
Vinci,
cool.
I
Uh-huh.
dug into Intuitive Surgical and started to get a better idea about that industry. So I've got a little bit of experience digging into it here, and I
Mm-hmm.
don't feel totally uncomfortable. So I'm going over on their website to their business overview, and and it's one of the major drop downs that they have there, and they just start going down through it. They have a Terumo Interventional Systems Division, which is to expand the potential of vascular treatment to raise patient comfort. And one of the first things they show is how you can use their stuff to put a stent in by just going up through the artery in the wrist. So you can just, because they've got the right kind of product, you can do that without, obviously it used to be open heart surgery, and then it became going up through your groin, I guess, and now you can go through your wrist.
So they're innovating. So, they're proud of that.
Innovating, proud of it. And they got a whole lineup of devices that covers all of the process, along with a big training program to use that. So you've got the introducer sheath, and you've got the guy wires, and you've got the angiographic catheter, and you've got the vascular closer device, and the drug-eluting stent, and the balloon catheter, and the peripheral stent, and the embolization coil system. I mean, it tells me that they are out to dominate this area. They want to sell the entire solution in this particular part of interventional medicine. Now, it doesn't tell me if their stuff is good, but it tells me that they've got a range of devices that cover all of the solution. So, I'm just kind of putting that into my head.
Yeah, exactly. What I hear, or if I were reading that, I would be going, okay, I don't know what that is. I don't know what that is. I don't know what that is. I kind of know what that is. That word is familiar, but I basically have no clue what they're talking about mostly in this paragraph. That's okay. Do I want to find out?
Do I want to?
Yeah.
And you know what? You may
I can
not
learn what those are. I don't think it would be very hard.
You may not, but I would, because I'm at that age where
I'm saying that's the question, is do I want to do the work to find this stuff out? Because maybe
I'm so glad you pointed that out. Because as soon as I started reading this list of stuff, the reason I kept reading it is because that was interesting to me. And the reason it is because I've had all that stuff done to me, not the stents, but, putting a camera up into your heart to look it over. At my age, you just got to go get the full cardiac evaluation. And this is all the stuff that they used on my wrist while I was wide awake. And I know I can call up Piedmont Hospital and say, who provided that stuff that you used on me? So that's immediately interesting. It's like,
you have a connection to it. You know
I eat that peanut butter. Yeah. Right there. So you guys, that's kind of the thing. And so from immediately right here, I'm already more interested in this than I was just trying to understand it as a guy that, a company that made bags. And now they do imaging, they do interventional oncology, where they deliver anti-cancer drugs directly to the organ that's affected. That's one division. That's TIS division. All right. Can I understand this? I absolutely think so. I don't think this is rocket science. I think this is interesting to me at my age, because I might be looking at any or all of these things down the road. And I would like very much to find out if these guys are what my local hospital providers use. And if not, why not? And if not,
what is it? Yeah, exactly.
Yeah. Who's doing their stuff? Yeah. Who's better than Terumo? And why? So already I can see the research on this being, number one, interesting, number two, doable relatively easily. And those two things go together to make me absolutely interested in this. So I think next step is to do a little work on this thing.
So I would frankly completely ignore the numbers at this point, because I don't care. I want to find out if this is a great company. And I'm interested in the area. I want to know what those words mean. So go for it. That would be my thinking. But you are much more numbers oriented than I am. So would you check the numbers, or would you?
I have to confess, I would check those numbers. Absolutely.
Let's be honest. Check the numbers before you ever read the paragraph you just read.
Let's be honest. I did. And I liked the numbers. I went over to, I Googled Terumo, investor relations. That's going to always get you to the investor page
website,
right? So investor relations, because sometimes a retail company will have a page that doesn't show any investor data because they don't want their customers digging into it. So I did that, and I looked at the numbers, and they're very good at putting the numbers out on nice graphs. because the numbers are very good. Everybody's happy to graph their numbers and make it real obvious what's going on if they're really good. And the numbers here are really good. And they do, in fact, show that 12 to 15% growth rate is consistent, lower in some of the recent revenue stuff, but higher in some of the net earnings stuff. And so, yeah, the numbers look good. They're very steady. And I have suspicion if I ran this through our predictability charting, we would find it to be a pretty predictable company at a high score.
Okay.
So
that gives
yeah,
you the undercurrent of confidence.
that gives me the undercurrent to, yeah, let's go dig into this guy. This is interesting stuff.
Very interesting.
Although it's not on sale. And this happens all the time. Get used to it. Wonderful businesses don't go on sale unless there's something that happens. And of course, what we're waiting for is something to happen globally, or in Japan, or, in the medical devices industry that'll put them on sale without it harming their company in the long run.
Yeah, that's the hard thing to hope for, isn't it?
Yeah, I hate to feel bad for them, but I want to buy in.
Intriguing.
Yeah.
Intriguing.
So
well, I hope that all of our listeners enjoyed looking at Terumo for a complete.
And happy Thanksgiving, everybody.
Yeah, happy Thanksgiving.
Yeah, have a good one. And be thankful for people like Buffett and Munger who make this stuff available to us. I mean, Charlie, God bless him, was so instrumental in making this fun. And Warren, it's so great about giving and giving and giving and giving and giving. And I just, we owe him so much.
We do.
Always thankful for them.
They didn't have to talk about anything ever.
God, no.
I always think of that.
Yeah.
Nobody has to.
Yep. They don't
it's
have
amazing.
to.
I think it's
all
fun,
right, honey.
But they didn't have to.
Love you a ton.
All right. Love
Very
you.
grateful for you. That's for
Very
sure.
Grateful for you too. Happy Thanksgiving, everybody.
Happy Thanksgiving.
And talk to you later. Bye.
Time to go play. See you guys. Hi guys, thanks for listening to InvestED. If you enjoyed this episode and you want more information or to listen to additional episodes, visit our website at investedpodcast.com and sign up for my virtual workshop right there. Spots are definitely limited for this event. I'm not kidding, they really are. They sell out very quickly. So everything discussed on this podcast, by the way, is either my opinion or it's Danielle's opinion. And really important, it's not to be taken as investing advice because I am not your financial advisor, nor have I considered your personal situation as your fiduciary. So remember that. You're on your own here. This podcast is for your entertainment and education only, and I really hope you enjoyed it.